You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
All right, everybody. That music means it is time once again for Options Insider Radio, the interview program here on the old Options Insider Radio Network. It's Tuesday. Must be interview day here on the network. My name is Mark Longo from the aforementioned network, as well as, of course, from theoptionsinsider.com. Glad to see you guys are enjoying the slew of content hitting you guys pretty much every day. We know people are pretty much still mostly stuck at home and also very worried about these markets, so we're doing our best to fill you up with great options-oriented content. Glad to see you guys have been downloading it en masse. If you like what you hear, keep those reviews coming on your platform of choice so more people can continue to discover. You know, we've been around forever, but there's always new folks out there to discover and find the content. We love to see the influx of new people. Let's keep it coming wherever you listen to this fine program. Leave a nice review. And, of course, if you have a question or comment, send it in. You know where to find us at Options on most of the major social media platforms, or just go to the website, theoptionsinsider.com. And you're off to the races. And joining me on the old interview program today, he's a newcomer to the program and indeed to the network. He is Dan CUPKOVIC, the Director of Investments at ARGI. Dan, welcome to the Options Insider Radio Network.
Hey, Mark. Thanks for having me. Really appreciate it.
And Dan, as we are wont to do with all of our first-timers on the network, why don't you go ahead and give our audience a little bit of an overview of your background, I should say, in the options and derivatives markets and how you found your way over there to ARGI.
Yeah, so I've been at ARGI. We're an RIA out of Louisville, Kentucky for almost 13 years now. Really grew up with the company. When we started, we were a couple $100 million shop. Now we're a $3 billion RIA. We do a lot of other things as a firm, including taxes, estate planning, insurances, financial planning, as well as investments. So I'm the leader of the investment department. We're 10 traders, PMs, et cetera, and we have, I think, over 24 different strategies, of which a handful are options-based. So really, as far as my option story goes, it's kind of a do-it-yourself story. I didn't really have a mentor. Lots of reading, lots of analyzing, lots of, trial and error and mistakes and kind of learning along the way. But I would say I'm probably most famous, if you can say famous, nobody knows about it, but most famous for the BlackSwan ETF, which is an options-based ETF we've worked with Amplify for and launched a couple of years ago.
I always like to see when people are kind of being lured to the dark side of options. Everyone has that different origin story in the space. I came through the more traditional means, not so much traditional anymore, of coming to Chicago, becoming a market maker on the floor, and fighting my way into the trading pits and all the fun that ensues as a result. You kind of mentioned you're a little more self-directed. What was it that brought you to the dark side of options there, Dan?
Well, I would say it's really understanding, because first, when you're coming into any investing as sort of a retail mindset thinker, you auto assume everything that you don't understand is risky. In options, even taking the Series 7, calls for buying and puts for selling, and that's all pretty much most investors ever learn. But then you realize, you can buy it, you can sell it, you can do spreads, you can do strangles. There's lots of intricacies that can scare a lot of people away. And it takes a while to kind of absorb all of it. So, I mean, really, and I'm not claiming to be a master, but it takes a good, 5 to 10 years to really understand the options market fully. And I think a lot of people just don't want to put in the effort.
No, that's certainly a challenge. We see that all the time just from the feedback from our audience out there on various spectrum. Could be on the professional side. Folks in the RIA space in particular, we hear about it all the time on our advisors option program, have really no concept of what's involved in options beyond what's on an exam like the Series 7 or something like that. And then, of course, on the retail side, it's a different story entirely. So it's always a challenge. You're right out there. But one of the reasons we wanted to have you guys on is because you guys are one of the few firms out there that actually has funds in the options-oriented space. It's a very small universe, as you well know. So walk us through, you kind of alluded to a little bit at the top there. Walk us through, what are your options-oriented products? What do you guys bring to the table from that perspective?
Yeah, so kind of our bread and butter is the BlackSwan strategy, and it's called BlackSwan, but it's not a pure tail risk strategy because at the end of the day, it has 90% of its money in treasuries, which are pretty safe and pretty simple. But that 10% is actually just in plain vanilla call options on the S&P 500. We buy 70 delta in the money call options, and it's targeting kind of a 50% upside of the market with a very low downside risk. And the truth is, for most kind of retirees that aren't going to be highly sophisticated, it's a pretty attractive strategy with phenomenal Sharpe ratios and a pretty good track record. So that's kind of the easy one to explain. We also, as a firm, have a covered call strategy called the Strike Zone, which we're basically selling out of the money covered calls on ETFs systematically. We do kind of 2-month rolls. We're targeting 30 delta, and there's a little bit more nuance to that. But also, for our more enterprising investors, we can do what's called opportunistic options. And that's really a cash secured put covered call kind of duo. You kind of find a stock you like, you sell a cash secured put on it for a price you want to buy it. Either you collect the income or the option drifts down, you end up buying it, and then you sell a covered call in it on the flip side. So kind of a yield enhancing covered call cash secured put duo. And that's pretty much all we're offering right now for the, retail investor on the RIA side.
I like the opportunistic options. That's what we traditionally call the wheel strategy here on the network, but it comes by many names and in many different flavors. Normally I would start there or maybe on the covered call side because I know our audience likes to lean into the premium harvesting a little bit, but given where we are and where we have been in the markets, I think we have to start with the BlackSwan. Now, traditionally, Dan, when someone comes to us with some sort of BlackSwan / tail hedging type portfolio, it's typically something that's invested in a large index, let's say an S&P, for example. Then they're going out with some sort of mechanism to hedge the downside, whether it's just straight up out of the money puts or put spreads. Maybe they get a little funky and they go on the ratio, so they're actually selling near-term downside puts and then buying more on the farther out of the money puts to really protect against that tail risk. You guys have gone with a little bit different structure. Explain to us, why did you go with effectively T-bills with a call kicker for your BlackSwan type structure?
Yeah, I think most importantly, it was simplicity. Like, too often I realize when we're dealing with these retail investors, if you start talking about spreads or you talk about, a multitude of different option strategies, they just look at you kind of crazy. And they're either going to trust you and let you run with it, or they're going to be skeptical and not give you the money. And I've often found that, they can become skeptical if it gets too complicated. So most people can understand, hey, we have these bonds, they're backed by the full faith and credit of the U.S. government. Okay, check the box. Oh, by the way, we have this home run money that happens to be elite call options that could go up a lot or down a lot to zero, literally. It was pretty close to zero in March on where we were. And they understand that, hey, I'm taking risk with this set amount and I'm willing to lose that set amount. So really, to me, it was the simplicity that really has garnered the most interest, in the fact that there's not a lot of moving pieces. And I think that's kind of a rarity in the options world. And I think that's why it's done fairly well. We have nearly $400 million in assets in it, and the fund's only been around for 18 months or so.
You know, you're right. People have this misperception, and you kind of alluded to at the top of the show there, that options are these complex, risky type instruments. And so if you come to them with something that's extremely esoteric, extremely complicated, ratios, leverage, all these other things going on, term structure, calendars, people's eyes start to glaze over, particularly in the pension and investment worlds, and certainly in the retail RIA client world as well. People start to back off. They're just inherently concerned about options. That's why we don't call this network the Derivatives Radio Network. It would be terrifying to people. You know, we stuck with options, a little bit less intimidating of a word. So you're right. There is a certain degree of attractiveness, something that is inherently simple. I mean, some people out there on the hardcore of our audience say, well, wait a minute, maybe you should do it like this and you could do it like that. But I think for a lot of the RIA audience, I think simplicity, you're right, might be a bit of a selling point. But our audience does like to get into the weeds a little bit. So walk us through it a little bit. How are you structuring these things? Are they 3-month, 25 delta calls? How do you go about the call side of the portfolio?
Yeah, so it's a good question. So we did analysis. We actually have a white paper on it. It was in the Journal of Investing last February, so you can Google it and check it out if you're really interested. We actually got the front cover. It's kind of like the BlackSwan movie, the girl in the tutu doing a leap. It's kind of funny. It's called Leaping Black Swans, but you don't die at the end. That's the plus.
Hey, you put Black Swan in anything, it gets attention these days, right? Sexy.
Yeah, well, yeah, exactly. That's part of the reason why we named it. We got
Talib has made an entire life off of that branding, right?
Yeah, no doubt. But so anyhow, we looked at various deltas and various maturities. And what we wanted to do with this was to minimize your theta decay, your time value decay. So we wanted to go further out. So we looked at 6 months, we looked at 1 year, we looked at multiple years. And it looked like kind of that 1 year leap was a nice sweet spot where we're 365 days plus one, as far, as close as we can get it. And we looked at kind of various deltas, whether we're going out of the money, in the money, and kind of your 0.6 to 0.8 deltas, kind of slightly in the money, seem to actually give you a little bit more bang for the buck as far as consistency of returns, and you don't really fall flat on your face in a flat year. So the whole point of doing like a 70 delta, year leap is when the market's zero, you're not going to lose 10%. You're not going to lose the entire value of that call option. And, that's a tough thing to explain if you're an advisor to a retail investor. Say the market's flat, we lost 10% with these derivatives, it'll scare them off. So we did the in the money, knowing that we'll still lose a little bit of that kind of premium from the time decay and from the price movement, but it's going to be harder for that to go to zero unless the market's actually down as opposed to flat. So it was kind of strategy based on knowing the mindset of the investor, coupled with trying to do as good as you can in a year that's kind of meh.
Yeah, that's a difficult balance to strike, right? You want to get enough deltas so that you actually can participate in the upside. You don't want to go with a 10 delta call. It's not going to really deliver the bang for the buck that you want. And you also want to go far enough out, so you're right, you don't really suffer from a lot of that theta erosion that would be if you were rolling 1 month calls, for example. That would be a very different picture. Speaking of rolling, do you guys have something baked in there where if it moves a certain amount, you can roll the call, or is it pretty much once a year type of strategy?
So in the ETF, we actually have a twice-a-year rebalance. So you have 2 tranches. There's a December and January. Each are 365 plus 1. And kind of when one comes up, we will then roll it to the following year. So we're not. We want to get as much exposure as possible. It's not designed to kind of be active. It's a passive kind of index-based product. So we're not really monkeying around with it on the ETF side. On the SMA side, so our separately managed account, we also have it internally as an SMA. We've ran it since 2014. We will talk to people and say, hey, maybe we should rebalance this, right? Hey, you're a big client. We're up a bunch. It's 2019. Maybe we should rebalance, shave some of that call option off, or vice versa. I had several people kind of rebalance back into the options in March, and a lot of those options are up 70, 80% now. So it's really more driven by conversations with each client, but otherwise we're just going to run the strategy as we run the strategy.
Let's talk about some of the other strategies, too. We could probably sit here and talk to BlackSwan for the entirety of our conversation, but you also mentioned the strike zone. Similar questions there. How do you guys construct it? Is it your typical, 25 delta call? You're going to meteor, and how far out? How do you guys construct that one?
Yeah, it's pretty plain vanilla for the sophisticated options person. We write 30 delta out of the money calls on 2-month cycles. So we typically target 60 days out to maximize the theta decay. And we write them on your typical kind of massive indices, IWM, Russell 2, EFA, EEM, and SPY. So it's a globally diversified covered call strategy for income generation and kind of maximizing the theta decay for it. Obviously, with some of that international exposure hasn't been phenomenal as of late, but we still like the strategy a lot for the long run. And as we get some sort of reversion to the mean away from U.S. large caps, which we started to see that with some small caps and mid caps doing well the last couple of weeks, but we'll see how that shakes out.
Yeah, it's an interesting little wrinkle you guys added where roughly half of it is exposed to international. You usually see these covered call funds. You're right, it's mostly S&P or maybe some NASDAQ or something like that. You don't see a lot of international covered call funds. So a little bit of a different flair there as well. And obviously we've seen a very tumultuous period over the past few months or so, I think to put it mildly. So challenging times to be launching and indeed managing fairly new options-oriented funds. What's the demand been like? What's the end user, the investor feedback been like over these past couple of months? Have they been calling up looking for these types of things? Have they been a little bit more gun-shy, especially when it was all hitting the fan back in March? What have the last few months been like for you and for these funds?
I would say, the strike zone's done better than long only just because we've been able to generate a lot of income in the high vol environment. Obviously, this last few months have been kind of a whipsaw with the market rallying so much, but it's still done fairly well year to date. Haven't gotten a ton of people kind of hammering on the door for that. The BlackSwan's obviously been attracting a lot of money, just seeing that it's done well year to date. I think we're up 6% or so, with the market pretty flat or down, depending on what you're looking at, the Dow, NASDAQ, or S&P. So we've got a lot of interest in BlackSwan because of what it's done. On opportunistic options, it's a little bit of a mixed bag. There's always some interest. However, a lot of those companies that we're going after are more valuation or value-based companies. And those, obviously, as many people know, haven't fared phenomenally well this year. Although I do think it's probably not a bad time to rotate into that a little bit. We're getting to those kind of 100th percentile extremes on value doing awful.
You mentioned the value and the recent recovery we've seen. Obviously, that's been a big point of contention and discussion on the network of late. I'm not sure if anyone really saw the aggressive return to normalcy that the market has priced in. We're pretty much back at all-time highs, if not exceeding them, in most of the major indices. So it's as if the pandemic and the recent unrest and everything else never really happened. Just a mere blip on the radar out here. I'm curious, Dan, obviously you're getting these questions, I'm sure, a lot from your clients and investors as well. What are your thoughts in general on what we're seeing out there right now from an overall valuation and just the aggressive speed of this recovery that we've seen out there, Dan?
Yeah, it's definitely unprecedented. I almost call it the Robin Hood return. You have so many people with trading at their fingertips now. You can buy and sell so easily, in many cases with no commissions. So we're just seeing extreme speed. I think it was 22 days from peak to trough and probably not that much from trough back up. It's just been literally an unprecedented time, and it's kind of hard to put into words. But a lot of that, again, I attribute to, the fact that we kind of shut our own economy down. It wasn't an external force biologically, but we made that decision, and we can make the decision to open it up depending on how we do that. But also just people reacting so quickly to news now that the markets can move tremendously fast, faster than they've ever done. Even in 08, 09, it was a way, way different trading ball game back then. And the ease of trading is so much easier. So I think those two things are a big reason why this has been such a jolt, both down and up.
Yeah, you mentioned how much it's changed since 08. That's a big point we've discussed on the network quite a bit as well. The overall context of the market, the universe of volatility, VIX as a tradable and indeed volatility as a tradable instrument and asset class is orders of magnitude different than it was back in 2008. We have a robust universe of options and futures and indeed ETPs on the volatility space, let alone, like you mentioned, everyone at home with easy access to effectively day trading accounts now out there. It is a very much different ball game. Speaking on that volatility side, I'm curious, obviously we saw a high volatility of late out there. VIX obviously spiking out around the 80 level, now back down shy of the 30 handle. Some people were speculating getting into this that we were looking at a new volatility regime, maybe that regime coming to an end. I'm curious, what are your thoughts on what we're seeing from an overall vol perspective out there right now, Dan?
Yeah, I mean, it was insane. I remember looking at the tape and, the volatility was over 80 on the VIX, and you could sell calls on it and get $6 to do 100. And, I'm sure some people did that. It was, an unprecedented time, so I didn't make that trade. But obviously those that would have made a lot of money. I mean, this is just further evidence that the VIX mean reverts. Like, it doesn't stay up forever, at least not over 50. I mean, I know in 08, 09, maybe it was 9 months, it was over 20, 25. And we may be in a period like that running up into the election, just with kind of the unrest going on, the corona uncertainty. So there's definitely going to be heightened uncertainty all summer, in my opinion. But sooner or later, we're going to get back down sub 20, and it kind of never fails. So, when the VIX spikes, it's probably not an awful time to sell premium on it if you have that iron stomach. And, this time was no different.
That's true. It does require a little bit of a strong constitution in those types of markets. We touched on it earlier in the show here, Dan, about you managing these options-oriented funds. It's still a relatively small universe. If you go over to Morningstar and look at what they term options-oriented funds, it's a very small list of funds, and a lot of them do a lot of different things, and they're all kind of lumped together. Some on their income side, some are on the tail hedging, some are almost completely different. They even throw them all into the alts category, and they throw managed futures in there as well, and all sorts of other strange things. But I'm curious, why do you think this universe of options-oriented funds is still so anemic? I mean, there's a handful of big funds out there that have any real substantial AUM, and that's about it, Dan. What do you think are really the obstacles to keeping more of these funds from getting out there?
I think a big thing is getting the word out, and I think you guys are doing a tremendous job in that, and having people understand that these are viable strategies for long-term investors and can often provide better risk-adjusted returns than just being a long-only investor. I think that's the most important thing to get across. I think it's a challenge to get sort of the news media and the investment professionals on that end to put the effort in to really understand and differentiate the strategies. So they lump it all in together, where you have, a tail risk strategy with our BlackSwan strategy, with a covered call strategy in the same universe, even though they're all trying to do very different things. I do think that in time, this will be fixed. I don't think it's going to be an overnight process, but as there's more education and more understanding and more products out there, then people will start to see the value add. I mean, if you look at, some of these buffer ETFs and other options ETFs that have come to the forefront, these things are 2-3 years old or less. So I do think as that proliferates and there's more options that people understand, it will just get better. But I do think we're in it for the long haul. It's going to be a 10, 15-year process to kind of get that understanding out there.
Well, Dan, that music means we've come to the end here on the old Options Insider radio program. We like to leave our audience wanting more. So if you want to leave them with a little bit of a hint and a little bit of a tease what they can expect from you guys coming down the pike, now is the time, sir, as well as if they want to learn more about what you guys have up your sleeves over there at ARGI, where should they go? What should they do, sir?
So we do have a couple things in the pipeline. They're still pretty fresh. We have an AI-based strategy we're working with a PhD on our team on, not directly options-based. And then also we have a short VIX strategy, hopefully not like the ones that blew up. I think we can kind of construct a portfolio a little more intelligently there. That's coming down the pipe here probably in the next year to 18 months. So we got some interesting things coming on. It's always working with compliance and with the investment committee, internally to make that happen. But we got some cool and unique stuff on the pipe.
Dan, short VIX strategy. All you do is sell a bunch of upside calls, set it and forget it, right? What could go wrong with that?
Until it rips your face off. You got to be very careful,
And if folks want to learn more about what you guys have up your sleeves, where should they go? What should they do?
Yeah, so ARGI.net, ARGI.net. You can go to the portfolio side, check out what we have. We have all our fact sheets on there. You can find my email and contact information if you'd like to reach out. Happy to, answer any questions or anything that comes up.
There you go, ARGI.net. That's ARGI.net. Give them a follow on the old Twitters while you're at it as well. It's ARGI Financial, ARGI Financial on the old Twitter machine. And Dan, I appreciate you joining us here to expand a little bit the still a very small universe of options-oriented funds, and we'll look forward to seeing how the BlackSwan and the Strike Zone, and maybe some of these forthcoming VIX funds and others, how they fare in the marketplace in the coming months, Dan.
Yes, sir. Thanks for having me.
Thank you for coming on. Thank you for joining us here on Interview Tuesday here on the old network. And stay tuned. We'll have a lot of fun stuff hitting the live stream, hitting the network throughout the week. So we'll keep you guys engaged, and we'll see you back here throughout the rest of the week. Tomorrow, we've got boot camp. Tomorrow, we've got OPR. Thursday, of course, TWIFO. And indeed, the old OB Friday Volatility Views. And it kicks off again next week with more Options Insider Radio.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.